as I am watching the coverage of the inflation numbers on mainstream TV, it really bothers me whenever they talk about food inflation, commodity inflation, wage inflation, right? They always have some kind of word that they want to use to preface inflation. This morning, we got another look at the government's report card on inflation. And of course, what makes this report card particularly unreliable is that the government is grading itself. Because after all, the government is creating inflation through the Federal Reserve, and then the government is reporting that inflation to the public itself. So the U.S. government is creating a lot of inflation, but the last thing they want is for the public to know there's inflation, because then they may have to do something about it. That is particularly true for the Federal Reserve, which for years and years has been telling us the problem is there's not enough inflation, that we need more inflation. Well, they really want to continue with that false narrative, and so they've never wanted to tell the public that we have more inflation, because then they'd have to stop pretending that we don't have enough of it. But it's the pretense that we don't have enough inflation that is what enables the Fed to get away with their excessively loose monetary policy. They're providing all this stimulus in theory to protect us from deflation. But if that's not really a threat, then on what basis do they continue with 0% interest rates or quantitative easing? So again, take these government numbers with a grain of salt, or at least recognize that whatever the number is, the actual numbers are much higher because the government doesn't have an incentive to report the truth, so we get a bunch of lies. According to the government, year over year, rents are just up 2.9%. And this is 23.5% of the CPI. Although I know rent in general makes up an even larger portion. I forget what the other rental components are, but the owner's equivalent rent is the single largest component in the entire CPI, and the government claims 2.9% year over year. The gain for 2021 annualized comes in at 3.23%, so a little bit more, but still much less than the actual increase. I think the last statistics I saw is that rents in 2013 alone, not just year over year, I think the last statistic that I saw was that in 2021 alone, not year over year, but just the 9 months of 2021, that rents are up about 12%. So close to 4 times the increase that the government claims when they're using the fiction called owner's equivalent rent. When the news came out that we got hotter than expected inflation, once again, the immediate reaction in the gold market was a sell-off. Gold actually was up about $14, $15 before the number. So gold was starting the morning strong. As soon as the number came out, gold sold off and went negative. Why? Again, I've explained it many times on this podcast. Whenever there is hotter than expected inflation, the market reacts by selling gold because they expect the Fed to put out that fire. So it's always bearish for gold, paradoxically, when we get bad inflation data, because the markets think that the Fed is going to do something about that bad data, and that doing something will be bearish for gold because they're going to fight inflation. They're going to raise rates. After that knee-jerk reflexive reaction, almost like just the computer algorithms have been programmed, worse than expected inflation, sell gold, sell silver, right? Buy dollars. That's normally what they do. Money immediately came in to take the other side of the trade. And gold had a very impressive rally. In fact, we closed the day near the highs, up about $33 an ounce, almost at $1,800 again. Not quite. I think about $17.93 is where we settled. Silver up better than 50 cents, just back above $23 an ounce. If you look at what happened in the bond market, normally when you get the worse than expected inflation news, bonds go down and yields go up. But today, the opposite happened. Bond prices rose and long-term yields fell. And the reason for that, I think, is maybe the traders are figuring out again that even if the Fed does taper or does raise rates to fight off non-transitory, worse than expected inflation, that the fight won't last very long. And while I'm talking about rising interest rates, there's one thing that very few people seem to appreciate or even discuss, and that is the effect that rising interest rates will have on consumer prices. Because as interest rates move up, both because the markets expect the Fed to raise them or because the markets build in a higher inflation premium to offset the lost purchasing power on their loans due to inflation. So as inflation causes rates to go up, that in and of itself exerts additional upward pressure on consumer prices. That's because interest rates are a cost. It's part of the cost of production. If you're a business and you're producing things, it's not just the raw material that you have to cover the costs, or not just your workers' salaries or your rents. You also have to pay interest on whatever money you borrowed to finance your capital investment or other parts of your business. And so that interest cost is baked into the production cost and ultimately needs to be covered by the end consumer in the final selling price. So I think the fact that you now saw traders buying the dip on worse than expected inflation news maybe means that this fantasy that bad inflation numbers are also bad for gold is now over. Maybe investors are realizing that bad news on inflation is actually good news for gold. And in fact, that is also borne out in the foreign exchange markets. The dollar was down across the board. Normally, we're talking about a stronger dollar when we get worse than expected inflation news. Instead, the dollar index dropped 0.4 to 94.03, one of the weakest days we've had in a while. Now, of course, this is the reaction that makes sense. If you find out that your dollars are losing value faster than you thought they were going to lose value, you should want to sell your dollars. But in this bizarro world that we're living in, news that your dollars are losing value faster makes traders want to buy dollars because they expect the Fed to react to this news by raising interest rates, therefore increasing the appeal of the dollar. Of course, this can't happen. See, what traders maybe are just finally coming around to understanding is that even if the Fed raises rates, we're only talking about nominal rates. Real interest rates are going to stay negative. Remember, we've got 6% annualized inflation, even by the government's own measure in 2021. The yield on the 10-year Treasury is barely over 1.5%. The yield on the 30-year Treasury is barely over 2%. This doesn't even come close to making you whole for 6% inflation, let alone the reality of what inflation really is. So these are negative real rates, and negative real rates are going to be with us indefinitely. And in fact, they're probably going to get even more negative even when the Fed eventually increases the nominal rates. I think they will do so at a rate that is slower than the acceleration in the rate of inflation. And these tiny rate hikes that the Fed may eventually impose will be too small to do anything to bend the inflation curve. So they will continuously fall further and further behind the curve, even as they inch up the nominal rates. The expectation for the rise in September was 0.3%, and that would have matched the 0.3% increase the prior month. And in fact, the prior month was the only month of the year where the actual number came out below expectations. Well, the September number proved the August number to be the exception to the rule, because once again, the actual number exceeded what was expected. We got a 0.4% increase in consumer prices month over month. Same thing with the year over year gain. The expectation was for a 5.3% year over year gain. That would have matched the 5.3% year over year increase in August, but instead we got a 5.4% increase. If you look at that year over year number, this is the fifth consecutive month where we have had year over year CPI gains in excess of 5%. But of course, if you take the numbers that have been reported so far for the first 3/4 of the year because we have 9 months now of CPI data. So if you annualize those 9 months to a full year, we are looking at 6% year over year. So if the pace keeps up, by the end of this year, we will have a year over year rate of 6%. As I am watching the coverage of the inflation numbers on mainstream TV, it really bothers me whenever they talk about food inflation, commodity inflation, wage inflation, right? They always have some kind of word that they want to use to preface inflation. But that really just lets the Federal Reserve off the hook for creating the inflation. Because if they say we have food inflation, well, now people want to blame the farmers, right? They're doing something. If it's wage inflation, well, let's blame those workers, or let's blame the unions, or whatever it is that they want to blame it on. But the real blame belongs with the Fed. And there is no such thing as commodity inflation. Commodity prices can rise and fall, but that's not inflation. And the only way that all prices could go up is if the Fed creates the inflation. Because if there are supply bottlenecks in one particular commodity and the price of that commodity goes up, the price of some other commodity is going to go down, or some other service to offset that, because there's only a certain amount of money in the economy. And if you have to spend more on one thing, well, then you've got to spend less on something else. So the only way you're going to get the price of everything going up is if the government is creating inflation, which is what they're doing, which is why we are experiencing this. But you never want to say goods inflation or wage inflation. It's just inflation. And if you just say inflation, then everybody knows where it's coming from, at least if you define it the correct way. It's monetary inflation. That's all it is. That's what's being inflated, the supply of money. And so that's why we're seeing prices going up.